So, you own a rental property in Canada. That means you're not just a landlord, you're officially running a business. And you know, the difference between that business being a success or just a massive financial headache, well, it almost always comes down to taxes. Today, we're going to break down the most common and costly tax mistakes that rental owners make and give you a really clear roadmap to help you avoid them.
Here's what we're going to cover. First, we'll talk about what the real tax problem is. It's probably not what you think. Then we'll get into the super simple financial foundations every single owner needs. We'll clear up that confusing line between repairs and improvements, expose a few tax traps you might not see coming, and finally, we'll talk about the one habit that really separates the successful investors from everyone else: planning ahead.
All right, let's dive right in. The real tax problem. When you hear tax risks, what's the first thing that pops into your head? Probably the tax rate itself, right? How much you have to pay? Well, for rental property owners, the biggest danger is actually something else entirely.
And this quote just says it all. The Canada Revenue Agency, the CRA, they're not really on the hunt for people trying to save a few bucks on their tax rate. What they're really focused on is compliance. So the real danger to your wallet isn't the tax percentage, it's the penalties, the interest, and all the audit headaches that come from messy records or just getting the details wrong.
This really gets to the heart of the mindset shift you need to make. We're all naturally focused on lowering our tax bill, right? But the CRA, they're focused on proof. They're basically asking one simple question over and over. Can you back this up? The second you start focusing on creating a clean audit trail with perfect documentation, you're aligning with their priority. And that, right there, is the best way to lower your risk.
So how do you actually build that bulletproof audit trail that the CRA is looking for? Well, that brings us right to our second section, your financial foundation. I'm telling you, getting this right from day one is the most powerful thing you can do.
And you know what? The solution is so simple. It's just 3 steps. Step 1, get a dedicated bank account. All the rent goes in, all the expenses come out. Simple. Step 2, get a separate credit card that you use only for property stuff. That's it. And step 3, just take a little time each month to reconcile those accounts. This isn't about being an accountant. It's just about creating a clean, undeniable line between your personal life and your business life. That separation is your best friend.
Because if you don't do that, this is what you're up against. A messy bank statement with groceries and Home Depot trips all mixed together, that's a huge red flag for an auditor. They can actually deny your expense claims just because the proof isn't clear. And think about it, every expense you can't prove is a lost deduction. It's like you're just handing money over to the government.
So how long do you need to keep these squeaky clean records? The magic number is 7 years. Yep, the CRA requires you to hold on to all your rental property records, receipts, invoices, bank statements, everything for a full 7 years. So get a good system going, whether it's digital folders or just a simple filing cabinet.
Okay, let's move on to something that trips up almost every new landlord. You spend money on your property, but is it a repair that you can deduct this year, or is it an improvement that you have to deduct over time? Getting this wrong is another one of those big red flags for the CRA.
Here's the easiest way to think about it. Just ask yourself one question. Did this expense restore the property, or did it improve it? If you're just restoring it to how it was, like fixing a leaky pipe, that's a repair. You deduct the full cost right now. But if you do something that makes the property better or makes it last longer, that's an improvement. That's a capital expense, and you have to deduct that cost slowly over many years.
Let's make this crystal clear with a few examples. Patching a leaky spout on the roof? That's a repair. But replacing the entire roof? That's a big improvement. Fixing a broken cabinet door in the kitchen is a repair. A full-blown kitchen renovation is an improvement. See the difference? Replacing one broken window pane is a repair, but upgrading all the windows in the house to fancy triple panes is definitely an improvement. It's all about the scale and what you were trying to achieve.
Now, that whole process of deducting improvements over time, that's called claiming capital cost allowance, or CCA. You can just think of it as depreciation. It's a tool the CRA gives you to account for the wear and tear on your building. But the most important word here is optional.
And optional means you have to be strategic. Just claiming CCA every year to create a loss on paper, that's a great way to get the CRA to take a closer look at your file. But the real danger is something called recapture. When you sell the property, every single dollar of CCA you've claimed over the years gets added back to your income for that year. It can create a massive, totally unexpected tax bill right when you think you're cashing out. Okay, so we've covered the basics, but now we're going to wade into the tricky stuff, the things you don't know that you don't know. These are the unseen tax obligations that catch so many new investors completely off guard.
Let me just ask a direct question here. If you have an Airbnb, a VRBO, any kind of short-term rental, do you have to be charging your guests GST or HST? The answer might actually surprise you.
Look, so many people just assume that residential rent is always tax-free. That is a dangerous and often costly mistake. As you can see, short-term places like that Airbnb often mean you have to register for, collect, and send in GST or HST. The same can be true for commercial properties. Getting this wrong is not a small oopsie. Trying to fix it later is an absolute nightmare.
Let's switch gears to another huge risk area, selling your own home. If you've ever rented out part of your home, like a basement suite, or maybe you moved out and rented the whole place for a couple of years, well, the rules around the principal residence exemption get really complex, really fast, and you better believe the CRA is watching these claims very, very closely.
And this is a rule so many people get wrong. You have to report the sale of every single property on your tax return, period. Even if the entire gain is tax-free because it was your home, you still have to report it. If you forget, the CRA can actually just deny your tax-free claim completely, and boom, you're left with a massive and totally preventable tax bill.
All of this leads us perfectly into our final, and honestly, our most important section. We've talked a lot about avoiding mistakes. Now let's talk about proactively setting yourself up for success. And the key is simple. You have to plan before you act.
Okay, look at this. This timeline shows the single biggest, most expensive mistake property investors make. They find a property, they get excited, they sign the papers, the deal closes, and then they call their accountant to ask about taxes. By that point, it's way too late. The decisions are made. The ideal path, the smart path, is to make that call before you ever sign anything. And just think about what one 30-minute phone call before you sign can do for you. Should you buy this place personally or set up a corporation? How should you split the price between the land and the building? These decisions have huge tax consequences down the road. That one call, that little bit of planning, can literally save you thousands, even tens of thousands of dollars.
And you know, this isn't a solo sport. The most successful investors know this, and they build a team. You need an accountant who really gets real estate, a great mortgage broker, a sharp real estate lawyer, and a good insurance advisor. These people are not expenses. They're investments in your success.
So we've covered the mindset, the foundation, and the plan. And the common thread through all of it is to treat your rental like a real business. So I'll just leave you with this one question to think about. Now that you know the biggest traps out there, what's the one thing you're going to do this week to start running your rental like the business it truly is? Thanks for watching.